was a sight for my soul.
Okay, so here we're going to go through Guardian and how loan interest rates work. So their 2020 dividend rate is 5.65%. That's what it will be. Their loan rate has a couple things we got to look at. So let's progress through them. Firstly, when I open a policy, their loan rate is fixed at 6%, and it is a direct recognition policy. We're going to go through a specific example and how that direct recognition treatment works, because it is different than what most people are aware of when it comes to direct recognition. Now, no matter what, I have that fixed loan rate at 6% for at least 10 years. It's locked in. I have the option at the 10th policy year to elect a variable loan rate, which has a present floor of 4.5%. This functions very similar to MassMutual and New York Life's variable loan rate as far as how it adjusts daily, how it's linked to Moody's Corporate Bond Index. A lot of consistencies there. The difference is that the floor is 4.5% instead of 5% with the other carriers. But I have to wait 10 years to get it. Now, if I do select that variable loan rate, the policy will then become a non-direct recognition policy. Now, if I don't select option 2, meaning year 10 comes and you say, you know what, I don't want to go with that variable loan rate. I'm going to keep the fixed loan rate of 6%. What will happen then is at year 20 or age 60, whichever comes last, meaning if I started a policy at age 55 and I'll be 60 in 5 years, I'd have to wait 20 years before this happens. And what this refers to is the loan interest rate will remain fixed, but it will drop from 6% down to 4%. And the treatment will remain direct recognition. Good to be aware of that. So let's look at an example here. We're going to assume I have a cash value life insurance policy with a value of $100,000. That's the cash money value. So that's how much I've got in cash. Dividend rate 2020 is 5.65%. We're going to focus here on the 6% fixed loan rate, and you'll see why. Direct recognition. So if I have a cash value of $100,000, I borrow out $50,000 at 6%. That means what? $3,000 of loan interest is going to be paid to the insurance company, not back to myself. Now, they're a direct recognition company. They recognize the fact that I pull out a loan, but I'm still going to earn dividends on this full $100,000. Because a company's direct recognition does not mean that they're going to just stop paying dividends on the borrowed funds. Here's how it works. The 50% that is not leveraged, meaning I still have it in cash value. Here what Guardian will do is pay me a dividend rate of 5.65%, whatever their dividend rate is. The funds that are leveraged or loaned, I still receive dividends on them. However, it's not 5.65%. It's 6%. What they do is match the loan interest rate. This way the client or the policyholder does not feel like he or she is going to be punished for borrowing from their policy. They don't want to discourage policyholders in that sense. Now, whether it's a 6% dividend or 5.65 or 100% dividend, always keep in mind that is a gross dividend, not my net IRR. So let's take a look at an actual spreadsheet here so I can compare and contrast. So let's take a look. We've got our same example that we looked at with MassMutual in the sense that we've got a $50,000 per year payment going into the policy for 10 years. 10/90 split, meaning I've got a $5,000 base premium and we're just plowing money into PUAs to accelerate the growth of the cash value, taking advantage of the company's limits, structuring it right with the term rider, all that good stuff. Now, crossover point, year 4, meaning crossover, break-even point, whatever terminology I want to use. By year 4, I've paid in a total of $200,000, 50 for 4 years, and I have $200,000, and it's compounding from that point forward. Got more money to use quicker. Exact same thing over here on the right. These two policies are identical. The difference is this guy is going to display a policy loan. $200,000, 6% of $200,000, $12,000. That's why I see year 1, $12,000 in loan interest. This particular example assumes I make 0 out-of-pocket payments in the first year, which is why that loan balance grows from $200,000 to $212,000. Now, when I pull from my cash value, view the cash value as the equity I have access to. If I want to think of it in a similar term or a relationship to equity in a piece of property, that's what I can access. The cash value is what I have access to, not the death benefit. So here I pulled 200, the net difference was 212 because the loan interest I didn't pay in the first year. 256 was my cash if I just let it sit and grow. Now, when I pull the $200,000, I pulled 200, I'm still going to receive dividends on that the full 256 as if I never touched it in the first place. What's going to happen is the unborrowed funds, 45, receives a dividend of 565, and the leveraged funds, 200, receives a dividend, let's put it up here actually, of 6%. So there's no slowing down, there's no missing out on an opportunity cost, no missing out on a compound effect. I'm still yielding appreciation on everything. A direct recognition policy will do that. They're just going to adjust the dividend rate on the leveraged portion. So let's try and bring this back down to earth, simplify a little bit. Death benefit is collateralized by $212,000, the loan interest because I didn't pay it in the first year. Dollar for dollar reduction. So if I die with a loan outstanding, just like a non-direct recognition company, the death benefit's paid out minus the outstanding loan balance. Now, as I repay it, we've got the loan interest column. Annual simple interest at 6%. This goes to the insurance company. We're repaying it at $20,000 per year. We can pay it back however we want. Here's what we really want to look at here. So when I take the actual policy, let's give ourselves a little bit more space. There we go. Is when that loan's paid back, what do we notice? Let's start with the example over here. When I'm 60, if I just paid money into the policy and let it sit and grow, the projected value is $888,000 and 1.998, just about $2 million. Versus the example when I borrowed at $200,000 and only paid the principal and interest. So the principal balance restored my cash value, and the interest payments went to the insurance company. Now remember that $200,000, that loan, any loan balance that was outstanding received a dividend rate of 6, not 5.65. And why I mention that? Look at this. Got about $10,000 more. The reason for that, 565 versus 6, is on the leveraged money, I had a 0.35% spread. They adjusted it upwards. Northwestern Mutual does something similar to Guardian, being a direct recognition company, but very high quality. Of the big four, the direct recognition treatment is favorable. It really doesn't make a difference when you compare it to non-direct, but it's good to see this kind of stuff. So here we've got the cash value difference, meaning in the example when I borrowed and repaid, my cash value is restored and some. Now it's also fair to say that the loan interest rate here is 6% versus a non-direct, like a Mass Mutual or New York Life, is 5%. So I see a difference there. I do pay a little bit more in interest expense, however they do make up for it. Good to be aware of this kind of stuff. So know the details. Main point here, Guardian is a direct recognition company. Initially, I do have the option to switch to non-direct recognition. If I did that, and took a loan here in this illustration after year 10, I would notice almost no difference. It would be very similar to a Mass Mutual example. But really the loan options, initially fixed loan rate of 6%. Year 10, I've got the option to go variable and make the policy non-direct recognition. If I don't do that, then at year 20 or age 60, whatever comes last, that fixed loan rate will drop from 6 down to 4%, remains direct recognition. And one side note here is that 4% rate, if I'm borrowing, they're going to credit a 4% dividend rate on the borrowed funds. They're going to do the exact same thing that they do with the 6% loan rate and the treatment, meaning they don't want a policyholder to feel like they're going to be punished for borrowing, but at the same time, they don't want to punish themselves, the insurance company, and other policyholders that don't borrow for borrowing. That's why they create that wash effect in a sense. Hope this helps.